In today's video, we're going to be talking about Qualcomm and how they are a great investment according to my valuation analyzer that we're going to get into later today. But also at the same time, why the chart looks just horrendous. So let's get into it. So as you can see on the chart, we have a head and shoulders pattern. As you can see over here, a bearish head and shoulders pattern is when you have a rise above a support zone and a resistance zone, creating the neckline, as we call it. You have a rise, you have a pullback to the neckline for your left shoulder. You have a higher rise for your head, a pullback down to this shoulder, and then another rise and another pullback to create the right shoulder and a pullback to this neckline. So, neckline, left shoulder, right shoulder, head. So, with a head and shoulder pattern, what you are looking for is a breakdown of the neck. So this is the neckline. So when you form a head and shoulders pattern, it doesn't mean you are going to just drop like a rock. We need what to happen? We need a breakdown of the neckline right here. When we get said breakdown of the neckline, that is extremely bearish. Not only that, but we have this volume shelf here and we have this little bit left that we're still hanging on to, and we just almost dipped underneath it. So we are almost dipping under this nice volume shelf here too, and we have a what? We have a volume gap. Part of my strategy, my high five setup strategy, is gapping up. Now this is a low five setup because we are gapping down, and I'm going to show you on the other indicators why it's a low five setup, not a high five setup. Low five setup meaning that it's going downtrending, downward. So with that, we have this massive price point between, I would say, 155 down to 150.65. So this was a little bit of a fake out to the downside and it rebounded pretty hard, but we are still holding this neckline. I would honestly say a break of 155, more than likely, we are going to come down and test out 137 to 138 and maybe even lower down to 125. But I really don't see it getting past 138. The measured move would be down here. So down to 107 to 130. I don't see that happening, but hey, anything's possible. This measured move would be about down here to almost $107. And I'm going to talk to you a little bit later about why I think this is such a great investment on the valuation analyzer tool that I have, Excel spreadsheet. But as we can see on the chart, you have a head and shoulders, which is a very bearish signal. You're approaching a potential breakdown of 155 to, like I said, I would wait until you break under this candle at about 150.61, so about 150 break, and then that's going to indicate to you like, yeah, we're going lower to at least 138ish, and then maybe even down to 125ish. So it's not just this that's screaming bearish. So for the low five setup, just like the high five setup, just in the opposite direction, we have a charting pattern that hasn't broken out yet. So we don't have a full low five setup. We have a volume gap on the volume profile here that checks that box. We have a downtrending MACD crossing below the zero line, even more bearish. We have a downtrending RSI purple under yellow approaching, not even in the oversold area. So we still have plenty of room to run down. And we also have been down here on the floor of the overextended area. But like I always say, you draw your consolidation box and it can stay in this box for as long as it wants. And I usually draw on the trend here. I draw my consolidation box up to the 32 line. And once we break that 32 line, that's breaking out of the consolidation box. And that essentially would be a sign of reversal. Up here on the Williams R, we had this pull up and break upward. And you know what? We don't have a consolidation box right now, if I'm being honest. This name is kind of been back and forth and kind of really when you get a name that's just like, going kind of crazy, up and down, up and down, up and down, big up, big down, kind of wicks everywhere, it's really hard for the Williams R percentage to keep up. So compared to like something like here, this nice consolidation and we headed lower. Here we are just, we're uptrending, right? Let's draw a trend line. So we're uptrending here, but actually we just broke down in the uptrend. So that's very bearish. So I'm expecting a pull down here. The snap back would be our resistance, and then we draw our consolidation box from there. And then as long as we go sideways, this name keeps heading lower. Now I'm putting this name out there. We're in a bull market, everybody. Do not short this stock. Okay. I'm just showing this as like an educational piece. Also to let you know, like, I think it's a great buy as we're about to get into, but I would just dollar cost average. I wouldn't, him haw into the whole thing. I wouldn't just, throw if you're gonna put 10K in the name, I wouldn't just throw 10K all in right now because we are seeing that it could go lower. And I use charts with my investing strategy as well. So I know when to buy in, when I know when to definitely DCA, or if something's on the bottom and then showing a reversal, I know like, hey, yeah, I got 10K and I want to get in this name. I'm gonna put the 10K in now. I'm not DCAing because I know the reversal's here or a high likelihood of it, right? So being a trader and being an investor, you can combine the two to be a ultra investor. You could be really good at this stuff by combining them, and you can combine it for selling covered calls, selling covered puts, and gaining that premium. I mean, there's so much you can do. You don't have to be a full-time trader. You don't have to try to be a profitable trader if you don't want to. You can. It's still important for you to learn this stuff because if you're just an investor in general, you would like to know where the markets are going overall, that we're in a bull market and we should continue higher based on everything we're seeing on the charts, right? These are important things to know, not just for traders, but for everybody, any investor. So get off my high horse. That's my little spiel. So we have a charting pattern, right? But we don't have a breakout yet. So we don't have the first setup of the low five, but we have two, a volume gap, we have three, we have four, and we have five. So we're almost there on the low five setup to have a complete low five setup for a downward move. But we're not there. And like I said, I would not short this name. I just would not short this name. The valuations on the floor. I will tell you exactly why this name just had great earnings, phenomenal earnings. They're growing on all fronts. They're doing great, but the semiconductor space besides Nvidia is weak. But your biggest thing is that Wall Street does not like that they are potentially going to acquire Intel. Now, it would be bad for Qualcomm stock, and I think that's when that is what I think would cause this to play out. This head and shoulders would play out if they do go ahead and acquire Intel stock. You can bookmark this, you can quote me on it. I do think if they acquire Intel stock, this head and shoulders will break to the downside and we will be going lower to about 138, and we can continue to downtrend for a year, right? Because they're going to have to they're going to have to assume control over all the debt that Intel has and the fact that their foundries aren't spun up yet and rolling. So, just so you know, that is why you will DCA this name and not just him haw into the whole thing, okay? Furthermore, um I did a write-up piece, and it'd be good for Intel, but there's one company that in an acquisition by Qualcomm, um acquisition of Intel by Qualcomm would affect and help most, and that would be Mobileye, because Qualcomm is so intertwined with all these legacy brands, a lot of legacy car brands that Mobileye isn't, and Qualcomm's spinning up their own autonomous driving and full self-driving network, and they already have a great connection with like the Apple CarPlay and the technology that's going in the cars, especially with their Snapdragon chip. So that is why I think you bring in Mobileye as part of that acquisition. I think that would be um, a almost bigger opportunity than Intel and, well, the foundry's pretty big, but, like, autonomous driving is so huge. So I'll say they're both pretty big, but it's something no one's talking about. If Qualcomm acquires Intel, they also get 80% control of Mobileye. And trust me, they ain't gonna sell out. They're gonna take them and basically probably buy them fully out, and then they're gonna sit there and have all that technology all the way up to level 5 autonomy, mix it in with what they already have, and also they have all those brands and they have all the partnerships and everything with all these legacy car brands. So I think it would be a massive partnership, a massive move for Mobileye. One being partnered with them. No one's talking about it right now. I think I'm first to the party talking about something like that. So yeah, massively bullish for Intel just because the buyout. So it'll run to whatever it's going to be, the intrinsic value that they pay. But Mobileye, I think once people realize they're gonna run even more crazy than they've already been running. Um, and that's why I'm positioned so heavily in Mobileye, and I'm not scared about the downward move because this is like my fallback plan. Like this is my fallback thesis, and I think it's a great thesis, honestly, for Qualcomm and for Mobileye. So I'm gonna buy every dip in this name because I think that's what's gonna play out. And then Qualcomm's not just gonna have their business and how great they are; they're gonna become a giant, and this company will become a multi-trillion-dollar company, like an Nvidia, like a lot of these other big tech companies. Why? Because they're going to be taking over the whole foundry business, which is a multi hundreds of billions of dollars of TAM, total addressable market, and they're going to be a big player because Mobileye is already a top 3 name within the autonomous vehicle market and the full self-driving market. So then they're going to launch themselves to compete with Tesla and Google, and it's just going to be massive for Qualcomm. You have the foundries, and then you're going to have full self-driving, and you're going to be improving that as well with your already vast um, vehicle lineup and partnerships. Just massive. Nobody's talking about it. If you tune into this video to this point, you're welcome. I just gave you a gem of all gems. If you're invested in Mobileye or you want to invest in Qualcomm, I believe if the partnership goes through, this company is on a amazing trajectory, and I love that it's selling off. And I hope the Head and Shoulders plays out. I would love a breakdown to 137 or even 125 or even down here to 110. Give me it. Give me it. Why, you ask? Why do I want that? Because I'm an investor in this company. I believe in this company for the long run. I just told you multiple theses about my bull thesis and where I think this company's going. Now, let me show you the numbers of why I'm so bullish on this name. So, this is my valuation analyzer. Essentially, what it does is we take 6 distinct key valuation factors and valuation numbers, and we sit here and say, what is our score? Do we have a 0 out of 6? Do we have a 3 out of 6? Or do we have a 6 out of 6? And obviously, a 6 of 6 score is very, very bullish. So let's run through the numbers. They are currently a $161 company. Their 52-week high was $231 almost. Their 52-week low was $122.63. And like I said, I think they could get down there if this Head and Shoulders breaks, right? They're a $178 billion company. And I just told you, I think if they do this acquisition, they could become a over $1 trillion company or multi-trillion-dollar company. That is huge. That is a multi-bagger of multi-baggers for a large company like this. Here we have if we just look across right here, we see it's basic. This is all right here, a discounted free cash flow model. Warren Buffett and Charlie Munger's, rest in peace, um, their favorite valuation tool, and it's one of my favorite valuation tools as well. So basically, free cash flow is king. Um, I look at free cash flow like that is king, and that tells me where the business is going. And I will value a company first off their free cash flow over everything else, because if the cash is flowing, it's going to continue to grow and flow more. They're going to have plenty of stuff to do. They can buy back shares. They can invest in themselves. They can, give out more dividends than they already do. I mean, so much stuff. That is the lifeline of a company. So, like I said, this is our discount free cash flow. These are our revenues. This is our revenue for projected this year, and then growing, high teens, and then going down to mid teens. So not even crazy growth numbers, which I think these spike up if they truly do acquire Intel and get Mobileye along with it. I think these can go up to low to mid teens growth rates, and that would just be crazy, crazy for this stock. Just absolutely phenomenal for this stock. So we take that and we extrapolate that out by 10 years, right? And essentially, we're going to do the same thing with our free cash flow, and we're going to do the same thing with our free cash flow less stock-based compensation, which is going to spit out intrinsic value and an intrinsic value less stock-based compensation. And right here, it's going to tell you the current margin of safety. So this is how far off the fair value, intrinsic value means fair value of the company. We're 20% stock-based comp. We're 32% on the non-stock-based comp, free cash flow, discounted free cash flow yield. We're about right here, little under 165, 66. And you see, if we get down to that 130, 125 area, we're going to be 40 to 50% current margin of safety under our intrinsic value. This is the value of the company, is what it should be. But obviously, news and sentiment and all these things can dictate and change that perspective. But the facts are facts and the numbers are numbers. They're increasing revenue. They're doing everything right as a business. It's just the news and the FUD out there and people not Wall Street not liking them potentially acquiring Intel and all that debt. They don't like it, but I think it's a great move. I hope they acquire them. More so for the Mobileye play, but also you get the foundry play in America. Immense opportunity. So to get these numbers, basically our 1 to 5 year and our 6 to 10 year, that's our free cash flow margin rate. So right now they're doing about a 33% free cash flow margin rate. So basically, the revenues that they're bringing in, 33% of them are going to, that's your free cash flow. So your margin rate. And then your last 5 years, I put it up to about 40% because that's on the current growth that they're going on. This kind of rate is always going to be 10%. Your terminal value, their free cash flow right now at these low prices, their free cash flow multiple is like a low 20s. And I'm only putting this at a 12 and a half. And if they acquire Intel, I think they get to low to mid teens. If they get to low to mid teens in growth, or just the fact, let's just use 15 at the end of our 10 years instead of when they're at 20 right now. Look how much it shoots up. Now we're at 262 fair value. And if you go down to a 10, it's still a buy. And that's what Charlie Munger and them usually use as a 10. But I like to change it around based on where they are now and where I think they're going, right? So we have our revenue, like I said, of 39.4, 39.38. It's just not showing the whole thing. Free cash flows right now of $12.6 billion are bringing in, just a cash flow machine. Stock-based comp is only $2.6 billion. So after stock-based comp, they're still bringing $10 billion worth of free cash flow. Their net cash to net debt ratio. So essentially, their cash and cash equivalents and investments versus like their not so great debt, like the debt they got to pay off right now, not right now, but like really soon, and like make sure they offset that. They're in the positive $11.5 billion. Positive, not negative. So they got plenty of cash. They got plenty of wiggle room on their balance sheet. Their balance sheet looks great. Total outstanding shares of 1.12 billion. Sorry, yeah, 1.12 billion total outstanding shares. And then our 6 indicators that we use. I already talked about the discounted free cash flow. So one right here is a check mark. Then we go free cash flow yield, forward free cash flow yield of over 7 basically for both. Over 7. You have Nvidia and a lot of these other mega cap and Mag 7 names, their free cash flow yield is essentially under 1. Under 1%. This is basically what shareholders are getting paid back um out of how much free cash flow they're making. These are massive numbers, massive. I usually like anything over 3 gets a green. So we're over double that. So just take that in mind. Anything between 2 and 3 gets yellow, and then anything below 2 gets red because that's not that great of a value. Then we come down here. Their EPS are expected to do this year is $10.28. For next year is going to be $11.34, giving them a current PE this year of a little under 16 and a forward PE of 14. For all this cash flow, for high teens revenue, for an acquisition of Intel that would be massive and they're massively undervalued. Yeah, I'll take this company all day. They have Snapdragon. They have so many amazing chips. They're in iPhones. They're in pretty much every phone. You know, they just have they have such a moat. They have such a moat in this market. And then their peg ratio is under 1, which is really good as well. So you have 1, 2, 3, 4, 5, and 6. You have your 6. So if we ran these numbers and kept them where they are, and I think this number is super, super low on your multiple of free cash flow, we have a 6 of 6, which is a great score. And what I really look for my biggest investments, Meta's still a 6 of 6. Google's a 6 of 6. So many of these other companies were a 6 of 6. They're not anymore because they've really ran away from their valuation. But I'm still in them and holding them, and then I trim based on my margin of risk. And this is something I personally created that I've never seen anybody else have. So you have a margin of safety, but I think you also need to have a margin of risk, meaning like when you need to know when to start trimming out of your position. You can hold it forever, but if we see like Tesla in 2021 runs up massively, hits a brick wall, and then has trended for the last 3 or 4 years. If you would have trimmed at the top, guess what? You could have bought more down at $100 or $180 like I was. So it's very important to have a margin of risk as well, because these keep going up as long as the company keeps going up. So you shouldn't have to trim, but eventually the numbers kind of get a little crazy, right? And the numbers start running away from the company, and then it starts time to start trimming. For this trimming, though, I will give it the actual forward free cash flow that I think it deserves before I start trimming, which would be like a 17 to 20 by the end of that 10-year time frame. Yeah, and then we have a 5-year CAGR of, if this all plays out, which I think it will, just to the fair value, guys, just to the fair value, we get almost 17% return per year over the next 5 years. That's not including once the hype really hits in and we go over fair value, because people will sell it off, and they'll sell it off too much to where it's undervalued like it is now. And then if you see like Palantir or Tesla back in 2021, they'll also buy the hell out of it and push it to way high overvaluations. It's just where the sentiment is, where the news is, and where the hype is. So almost 17% CAGR next 5 years, over 11% CAGR for the next 10 years. And like I said, if you bump this up to like a 15 or 20, where I think it's at, you're getting over 12%. The average market return is about 8 to maybe 10% on a annual basis. So you're beating the market with this name. I think it's a great investment. Don't invest in it just because I'm investing in it. My thesis. Invest in it after you do some research and you understand it. So, and this is a longer video, but I feel like I gave a lot of great advice, and I gave a lot of insights into how I look at trading, how I look at investing, and how I use them in a combination of my investments. So drop a comment below if you're interested in buying Qualcomm, or you think a yay or nay if you think they're going to buy out Intel. I appreciate if you stuck around to the end of this video, and I'll catch you guys in the next one.